Welcome to the deep dive. Today we are tackling, well, one of the most consequential companies on the planet right now, NVIDIA.
That's right. We're going deep into their Q3 FY26 results, the whole strategic landscape, and just the unbelievable velocity of their growth.
And our mission, as always, is to take this huge pile of reports, financials, analyst notes, and give you the absolute fastest path to understanding what matters.
We want to unpack their performance, get into the mechanics of accelerated computing, and really analyze the big financial and geopolitical factors that are shaping their future.
And the key headline here, it's just all about scale. We're anchoring this whole conversation on a record revenue of $57 billion for the quarter.
Up 62% year over year.
Exactly. But the number that really stands out is the data center segment, $51.2 billion.
Up 66%. This isn't just growth anymore. This company is fundamentally reshaping its entire relationship with the global economy.
Right.
Use that term, reshaping, and that's really what you hear in the CEO's commentary.
What are they saying?
The sources quote them saying things like, Blackwell sales are off the charts, and that cloud GPUs are sold out.
Wow.
So this is not just about selling chips. This is about building the literal foundation for, well, the next industrial revolution. It's them signaling they are deep inside what they call the virtuous cycle of AI.
Okay, let's unpack that virtuous cycle. When a company is this big, this dominant, how is this growth even sustainable? Doesn't it have to hit a ceiling at some point?
You'd think so, but the sources really suggest it is sustainable, and that comes down to the financials and their forward visibility.
Yeah.
So Q3 revenue confirmed $57 billion.
Okay.
And the diluted EPS, both GAAP and non-GAAP, came in at a clean $1.30. But the real story is in the future.
Right.
They say the growth comes from these three huge simultaneous platform shifts. First is accelerated computing itself. Second, these incredibly powerful new AI models. And third, the emergence of what they call agentic applications.
Okay, hang on. Agentic applications. That sounds like it's straight out of science fiction. For you listening, what does that actually mean?
It really does. But we're talking about very sophisticated, autonomous software. Think way beyond a simple chatbot.
So not just answering questions.
Not at all. Agentic applications are these intelligent programs that can handle really complex multi-step tasks without a human having to guide them every step of the way.
Like what? Give me an example.
Think of an autonomous trading system that manages a whole portfolio, or a supply chain agent that is dynamically rerouting cargo all over the globe based on real-time data. There are systems that just consume massive compounding amounts of computation.
And to fuel that future demand, they've given this sort of unprecedented look into their future sales.
They really have.
Sure.
And this is where the scale just becomes mind-boggling. The company has projected visibility into $500 billion in Blackwell and Rubin revenue.
$500 billion?
Yes. And that's just from the start of FY26 through the end of calendar 2026.
So that's not just a strong pipeline, is it? that changes the whole business model.
It completely changes it. When your customers are committing to that kind of supply years in advance, NVIDIA starts to look less like a component vendor and a lot more like a critical utility, like the power company. You have to secure your capacity from them.
That reframing a utility provider, that is a huge insight. Their customers see this as essential infrastructure. Okay, but let's talk velocity. Not just year over year, but quarter over quarter.
The sequential growth is almost impossible to process. Revenue went up by a record $10 billion in one quarter.
Just from Q2 to Q3.
Just from Q2 to Q3. That's a 22% increase. Adding $10 billion, which is the annual revenue of a lot of Fortune 500 companies, in just 90 days, it just shows you how urgent customers are to get their hands on this hardware right now.
How does that kind of speed even work internally? The stress on their supply chain and their execution must be immense.
Oh, it creates enormous stress. And we'll get to that when we talk about capacity risks. But it also confirms that their whole investment thesis around the data center is, well, it's dead on.
So the data center segment really is the engine here.
It's the whole engine, $51.2 billion in revenue. And we really need to break down how that's generated. It's split between compute and networking.
Compute being the GPUs, that's got to be the biggest piece.
It is. Compute brought in $43 billion. But the really interesting part, the strategic part, is the other piece, networking. That hit $8.2 billion.
Wait, $8.2 billion for networking gear? That is a massive business on its own. What's the growth rate on that?
It's staggering. The networking segment grew 162% year over year.
162.
Yes. The sources actually confirm that NVIDIA is now officially the world's largest networking business. And this isn't an accident. It's a deliberate strategy. It proves that a modern AI factory needs their specialized architecture, NVLink, InfiniBand, to move these huge amounts of data around. Conventional Ethernet just can't keep up.
So that crazy growth in networking isn't just about selling more stuff. It's proof that customers are buying into the whole ecosystem. It basically locks them in and creates an even deeper moat for the company.
Precisely. They are not selling parts. They're selling a full-scale solution. And that brings us to the big architectural shift that's happening right now.
Which is?
The move away from the established Hopper systems over to these new Blackwell full-scale data center solutions.
Let's clarify that term because it gets thrown around a lot. A Blackwell solution is not just the next GPU, is it?
No, it's way more than just the chip. The solution includes the Blackwell GPU architecture itself, but also the specialized networking, the interconnects, the server design, and this is critical, the entire software stack that makes it all work together.
It's a totally vertically integrated system.
Exactly. And what's fascinating is how fast people are adopting it. The sources say Blackwell Ultra is already the leading architecture across all customer types. It's immediately taking over from Hopper as a strategic focus.
Okay, let's shift gears for a second. The data center gets all the attention, but the rest of the company is growing too, right?
Oh, absolutely. The growth is comprehensive. It shows how the R&D sort of benefits all the different parts of the business. Gaming revenue hit $4.3 billion.
Which is up 30%.
Up 30% year over year. And that segment is still really important. It gives them high-volume manufacturing experience. It drives graphics innovation like DLSS 4. The sources mention key game launches like Borderlands 4 and Battlefield 6 helping drive that.
And professional visualization.
That one's at $760 million, up 56% year over year. This is where you see AI moving into, professional design and engineering. They even announced this thing called the NVIDIA DGX Spark.
Right, the world's smallest AI supercomputer.
Exactly. And making it smaller, more accessible. That's key to getting AI development out of the giant cloud data centers and into, say, corporate research labs.
And finally, automotive. This always felt like a longer-term bet, but the numbers suggest it's starting to pay off now.
It's definitely accelerating. Automotive revenue was $592 million, up 32%. And the sources give this really concrete example, a partnership with Uber.
What are they doing?
They're scaling what's going to be the world's largest Level 4 ready mobility network. They're targeting 100,000 vehicles starting in 2027, all using the Drive AGX Hyperion 10 platform.
So that's a huge, clear pipeline for future revenue. It's a nice diversification away from just building out data centers.
Exactly.
Okay, let's connect all this market dominance back to the balance sheet. I want to talk about margins and their spending strategy.
Right. And you probably noticed the margin saw a temporary dip.
I did. DAP gross margin was 73.4% versus 74.6% a year ago. A similar story for non-cap. So with revenue just exploding, why are margins tightening even a little bit?
It's a great question, and the company's actually really clear about why. It's transition costs.
The move to Blackwell.
The move to Blackwell. That slight compression is almost all because of the aggressive shift from the established Hopper systems to these newer, more complex Blackwell solutions. There are huge initial ramp-up costs, new supply chain stuff, more engineering support. It temporarily squeezes the margins, but the idea is that they'll bounce back once Blackwell is optimized.
And to manage all this growth, they are obviously spending a ton of money. How big was the increase in operating expenses?
They're investing very, very heavily. GAAP operating expenses jumped 36% year over year. That's from $4.3 billion last year to $5.8 billion this quarter.
That's a big jump.
It is, but it's entirely strategic. The sources call it investing to address the multitude of growth opportunities ahead. So that's CapEx on compute, hiring top talent, and just massive engineering costs for new products. It's a high-stakes bet. Spend big now to secure that future revenue.
And what of cash flow? How are they rewarding shareholders through all this?
The free cash flow is immense. It jumped from $16.8 billion to $22.1 billion year over year. That kind of cash generation gives them incredible flexibility.
And for capital return?
They returned $37 billion to shareholders in the first 9 months of the year, mostly through buybacks. And they still have over $62 billion left on their current repurchase authorization.
So, huge financial firepower. Looking ahead, what does the Q4 guidance tell us about their confidence in this Blackwell transition?
The guidance is incredibly bullish. They expect revenue for next quarter to hit $65 billion, give or take. And, crucially, They expect non-GAAP gross margin to pop right back up to 75%.
Okay.
So that suggests those transition costs we just talked about. They expect them to smooth out almost immediately. It's a big vote of confidence in the economics of the new Blackwell systems.
Okay, so when you build a skyscraper this fast, the foundation has to be flawless. The financials look solid, but the biggest cracks I see aren't technical. They seem to be geopolitical and infrastructural.
That's the perfect way to put it. We have to talk about the risks, starting with the huge financial cost of the U.S. export controls on China.
Right. What's the bottom line impact there?
It's a very clear example of policy creating immediate financial pain. Because the U.S. government requires a license for their H20 products going to China, the market demand basically collapsed.
Yeah.
The company had to take a massive $4.5 billion charge in Q1 for excess inventory.
4.5 billion. That is the real-world cost of a single foreign policy restriction. It's a staggering number.
It is. It really shows you how severe the regulatory pivot was. And to make it worse, in this current quarter, Q3, the revenue they actually made from H20 under the licenses they got was only about $50 million.
So the market has just evaporated.
It's been incredibly constrained.
Mm.
And beyond that specific H20 issue, the whole regulatory landscape is still just uncertain.
There's no stability.
None. The sources mention the AI diffusion interim final rule got rescinded, but there's a lot of ambiguity about what comes next. Then there's the GAIN AI Act and the NDAA. All this constant policy movement just makes long-term planning, especially for foreign markets, incredibly difficult.
And speaking of planning, the sheer scale of this build-out creates these huge capacity risks that have nothing to do with politics.
Absolutely. The sources are really clear that the supply chain has very long lead times, over 12 months, for some key components.
In a year.
A year out. So to manage that, they have to make huge commitments. We're talking $50.3 billion in production and supply commitments, plus another $26 billion in cloud service agreements. That's over $76 billion in long-term liabilities they have to manage against this constantly shifting backdrop.
And the risks aren't just in the chip supply chain, are they? What are the non-chip factors that could actually slow this whole engine down?
This is maybe the most important point. The biggest bottlenecks are entirely physical and infrastructural.
Okay.
The sources are blunt about it. Shortages of data centers, not enough reliable energy, and even just access to capital for their customers could all severely limit future growth.
So it's not about the silicon anymore.
It's not. They explicitly say that expanding energy and data center capacity is a complex, multi-year process. Regulatory hurdles, construction, technical challenges. The speed of AI is now literally being bottlenecked by power grids and concrete buildings.
It seems like they're trying to get ahead of that by investing directly in their own ecosystem, right? Becoming investors in their future customers.
That's exactly the strategy. You see a letter of intent with OpenAI. You see an agreement to invest up to $10 billion in Anthropic, a commitment for $5 billion in Intel. These aren't just passive investments. They're strategic anchors to make sure the biggest users of their hardware have the capacity to keep growing.
It's a way to de-risk their own pipeline.
It is. And we should also note, while just 4 direct customers made up a huge chunk of revenue, 59%, the end users are spread out globally. So for revenue from, say, big Taiwan-based customers, about 86% of that actually goes to end customers in the US and Europe.
So the demand is truly global.
It's driven by the global hyperscalers.
So the key takeaways here are pretty clear. We've got unprecedented financial growth. We have this huge transformative shift to Blackwell. Their networking business is creating this critical moat. But all of that good news is balanced against, well, profound geopolitical risk and the simple physical limits of energy and construction.
That's the perfect synthesis. For all the phenomenal growth and the bullish outlook, the sources force you to see this heavy dependence on massive long-term capital and very uncertain regulatory clarity. The demand for AI is proven to be exponential. The real question is whether the physical world can keep up.
Which brings us to our final provocative thought for you to consider. Given that building out energy grids and data centers is this complex multi-year process, how quickly can the physical infrastructure of the world possibly catch up to the compounding exponential demand of AI compute?